Welcome to Key Points for the month of October. This month, why we think the Italian budget is a step back for Italy, why markets have rallied despite further trade tariffs, and why we think the US will hike rates for a ninth time in December. So turning to our first point, we've just seen the high-level budget deficit plans for the next 3 years in Italy, which frankly are disappointing. A deficit of 2.4% for each of the next 3 years is a lot more than we had expected and more than investors had been pricing in. Now, we haven't seen the details for 2019 yet, but it is certainly higher at 2.4% than the finance minister has been leading us to believe in recent weeks, of around about 1.6 to 2%, which had allowed Italian BTP spreads versus bunds to come in quite significantly. Now, unfortunately, we think this is negative for Italy on a number of levels. We're currently going through a process where the S&P and Moody's rating agencies are reviewing their outlook for Italy, and we think given the debt to GDP ratio of 132% and this budget is likely to lead to a possible downgrade. Secondly, it's going to impact business investment. And that's going to, of course, have a knock-on effect in terms of the economy going forward and put Italy in a less robust position that it's been in. And for us, this is really important because when the next downturn comes, the Italian government has certainly stepped away for taking some of the reform measures that are really needed to make growth more sustainable and robust longer term. Now, turning to our second point, we've seen the tariff wars escalate in terms of the imposition by the US on Chinese goods and vice versa to a somewhat lesser extent. Now, interestingly, the financial markets have rallied quite considerably despite this, and there's a couple of reasons for that. I think the first one is that the actual level of tariffs themselves imposed by the US are slightly less than had been expected, although this will ramp up from the 1st of January next year. But importantly, the response by the Chinese has been rather measured. It's on 60 billion of goods, and they were quite explicit that they weren't going to use a devaluation of their currency as part of what is now this bilateral trade war between the two countries. However, unfortunately, this tariff issue is going to drag on for some months, lingering for longer, and therefore you're going to get bouts of volatility as more announcements are made. Now, turning to our third point, the US economy is still booming. We've just had the 8th rise in interest rates by the Federal Reserve, taking their upper bound to 2.25%, and we suspect there will be another rate hike when we get to December. And there's good reason for that. As I said, the economy is doing really well. We're seeing small business optimism at a record high. Business investment intentions are at a 12-year high, and initial jobless claims are at a 45-year low. There is no doubt this is an economy that's growing above potential. And indeed, even inflation has finally crept up to kiss the Fed's targeted core PCE level of 2%. So as a result of that, we think the US economy is in good shape. It can weather this further rate hike. But remember, we do suspect there will be a slowdown as we get into 2019. The financial tightening will have an impact. The reduction in the balance sheet will also take its toll. And we'll see some running off of the fiscal stimulus that have taken place. So a slowdown in 29 is still expected, and a further rate hike this year is to come. Remember, for full details of everything I said, you can read all about this in our October Investment Insights publication, which is available along with all our publications on zurich.com/MSME.